For more on this, we're joined by Nour Al Hammoury, who's Chief Market Strategist at Equiti Group. Welcome back to the programme, Nour. Now, markets are settling into a more measured tone as that initial excitement over an agreement between the US and Iran begins to fade. So what's behind this reassessment now, so as to say?
Good morning, and thank you for having me. The first reaction was driven by relief. Investors immediately priced in lower oil prices, lower inflation risk, and reduced chances of further military escalation. Brent crude has also fallen sharply from the war high, and global equities have reached new records on hopes that the Strait of Hormuz will fully reopen. But now markets are moving from headlines to details. Investors want to know how quickly oil flow normalize, what happens with the sanctions, and whether all parties remains committed to this agreement. Here also you have to understand that the markets are no longer trading the peace announcement itself. They're trading the implementation risk. And if the agreement holds, it becomes a global growth story. And if it stalls, volatility could return very quickly.
Meanwhile, defence stocks are already surging. Is it too early to buy into this post-war boom?
I think investors should be very careful about assuming that peace means lower defense spending. One of the biggest lessons from this conflict is that countries don't wait for the next crisis to prepare. That's across the Middle East, Europe, and even Asia. Governments are likely to accelerate spending on missiles defense, drones, cybersecurity, and even surveillance systems. Here also, you have to understand that also investors, or they have to understand that defense is increasingly becoming a technology story rather than just a military story. The winners may not be traditional weapons manufacturers alone, but companies involved in AI, satellite communications, autonomous systems, and cybersecurity. So while some defense stocks may look expensive after the rally, the long-term spending cycle could still have years to run.
Over in Japan, the Nikkei crossed a new record high earlier in the trading session following a historic interest rate by the Bank of Japan. What does this tell us about investor confidence in Japan, and is this rally sustainable?
This is actually a very important signal. Historically, rates or rate hikes were seen as bad for stocks. But in Japan, investors are interpreting them differently. The market is viewing higher rates as a proof that the economy is finally strong enough to stand on its own after decades of ultra-loose monetary policy. Now, what's driven the confidence is not just monetary policy. Japan is also benefiting from corporate reforms, strong technology exports, rising wages, and renewed foreign investment flows. The Nikkei has been also one of the best performing major markets globally. Here also, I would like to add that the sustainability of the rally depends less on interest rates and more on earnings growth. And if Japanese companies continue to deliver profits and productivity gains, investors may view pullbacks as another buying opportunities rather than just the start of a bear market.
Right, and meanwhile, China's retail sales fell for the first time in 3 years, accelerating the need for potentially more government measures. Can lower oil prices save its stumbling economy?
Well, first of all, I mean, China is not in that huge of a trouble. Lower oil prices, yes, certainly help because China is one of the world's largest energy importers. Cheaper energy reduces costs for manufacturers, consumers, and also transportation networks. But however, lower oil prices also alone won't solve China's challenges. The biggest risks or issues are weak consumer confidence and also a struggling property sector and a slower domestic demand. Oil can provide some relief, but it cannot create spending demand by itself on its own in a very short period of time. Here also, Beijing may actually welcome lower energy prices because they give, or it will give policymakers more room to stimulate the economy without creating inflation pressure. And in other words, cheaper oil prices is a helpful tailwind, but meaningful recovery will still depend on targeted fiscal support and measures aimed at restoring consumer confidence. If you might say the bottom line here is that lower oil prices can help China stabilize, but they are unlikely to be the catalyst that fully reignites growth on their own.
No, great to speak to you, Eldeen Hammoury in Dubai. Thank you very much as always.